right, guys, welcome back to another episode of Sky's the Limit Podcast. I'm your host, Mike Doherty, and today we have an awesome guest, Thomas St. John from Corp Capital, LLC. Tom started his investing journey with determination and drive to learn. Over the past 20 years, he's built and scaled a real estate portfolio by improving operations, increasing efficiency, and maximizing returns. In the last decade, he's acquired multiple multifamily properties, successfully boosted NOI, to create long-term investor profits. He's owned and self-managed hundreds of units with deep experience overseeing tenants, projects, and teams and property management. And most recently, Tom has been more focused on private alternative investments, helping hundreds of investors place capital into high-performing assets alongside top operators nationwide. So Tom comes here from tons of experience. And with that, Tom, welcome.
Thanks a lot. Well, happy to be here, Michael. Thanks for having me.
So one question I always like to ask all of our guests is, how the heck did you get started in real estate investing?
Yeah, I have answered that a lot, and I like talking about it. I'll just give, not to go too deep, but 2004, 2005, my dad retired. He had a heart attack on a golf course that kind of forced him into retirement. You know, he was okay and everything, but I just remember him being on the hospital bed and telling my mom, whatever we have. Whatever we got. And it was a few weeks after that, he got a big package in the mail from his employer. It was a big telescope. And he was real excited, we're looking at the moon and stuff. But I just looked at that telescope for some reason, I felt like my whole life was laid out in front of me. 32 years of working in a factory, and his reward was a telescope. So I kind of at that moment decided to just to find another way. So I just started going to the library, reading books, finding people. I've always had that kind of entrepreneurial spirit. And very quickly I realized real estate was kind of the thing for me. I was kind of addicted to it really from day one. And for the last 25 years, that's all I do: eat, sleep, and breathe this stuff.
Yep. So what did you do before you got started in real estate investing?
Well, actually, I was a mailman.
Okay. All right.
Yeah, I'd walk around, and that's kind of how I started buying a few properties. I would call, not so much on my route, but I would drive around and call for rent signs. I figured if a house was for rent and it was vacant, maybe the landlord was wanting to get rid of the property. So those days are kind of gone where you have to drive around, with the internet. But I was doing that, and then I always wanted to be in the fire service. I think probably from 9/11 was kind of my generation's Pearl Harbor. A lot of people probably relate to that. But so really quick, I was only in the post office for a few years, and I got in the fire service. And public service, I really enjoyed. I had a lot of passion for the fire service. I still do. I still work in it from time to time. But that's what I was doing before I really found real estate.
Yeah, no, that's awesome. And I think a lot of listeners could probably relate to that, where they're working some, W-2 job for someone else, where you're making someone else money, and then kind of have this epiphany or this aha moment where you realize, okay, I'm spending all my time and working for someone else. How can I kind of shift that mindset or shift that momentum and have money work for me, and have money work for me while I'm sleeping even? So you started your earlier days with single family houses, if I'm not mistaken. Would you recommend other investors, other listeners, to start in the single family house, whether it's flipping or just owning single family rentals, because it's a little bit easier to get into versus multifamily, certainly easier than like a 100-unit apartment building? How did you get your start? What did your first deal look like? And would you recommend that same kind of path for some of the listeners today?
Yeah, I would recommend single families or smaller multifamilies. I think there's a ton of value in being able to say that you owned and operated, in the trenches, doing all the work before you go out and start, raising capital from retail investors or people or people you don't know. I mean, you don't have to.
Mm-hmm.
For me, I wish I would have grown, or decided to grow to larger scale sooner. But the fact that I waited, or it took me 10 or 11 years to really get into multifamily and to scale a portfolio, it was a long time for most, but it did serve me quite well. with investors, banks, strategic partnerships, knowing that at that time, I had 10 or 11 years of managing. At that time, I think it was, around 50 or 60 single family houses. You just don't get to 50 or 60 single family houses by accident. So I didn't really have to prove myself, I suppose, to anyone. But yeah, 2004, 2005, when I decided to start in real estate, it took me about a year to even get my first one. I had fix up some credit stuff, save a down payment. And I bought my first house around Christmas of 2006. And, it's always funny from 2006 to 2008 or nine, I think I had like five or six houses, I was able to save up enough money and, leverage some of the properties to buy more. But then 08, 09 happened, the big, GFC, the great financial crisis. And then I didn't care that the prices went down by 50%. To me, I was like, I knew this was a waiting game, a long play. But the problem for me back then was the credit crunch. You couldn't walk into a bank and get a loan for anything. So it was very difficult to acquire properties at that time, even though I knew they were very discounted. So this is what I don't recommend people doing is I went out and did all kinds of crazy stuff, hard money loans, crowdfunding platforms. Like, I don't know if you remember, like Prosper and Lending Club. I did credit cards for down payments. I did a bunch of seller financing and real high leverage stuff. To me at the time, like I wasn't risking anything because I didn't have anything. And I didn't have anyone else's money or time invested anyway. So to me, it was just more about acquiring property at that time. And I took a lot of it worked out, I suppose, but I took a lot of unnecessary risks from, I would say, '09 to 2012, maybe in that area, just acquiring property because I knew they were discounted. But to answer your question, like I'm not going to write a how-to book or recommend someone repeat that. It was
Right.
If I wrote a book about that, it would be called Brain Damage.
That's fair. I mean, yeah, there's so many different ways to get started. I do think single families, there's less going on. So for your first property, it's one tenant to manage. You're not buying some 4, 6, 8 unit multifamily, and you got
Mhm.
8 different people reaching out to you at all different times. I think leverage and debt used prudently does make sense. I'm not on the full like Dave Ramsey, have everything paid off, but I
Yeah,
also don't think taking unnecessary risks is important too, or is good
yeah,
to do too. You felt comfortable doing those
yeah,
because you knew your market and you
yeah,
knew your numbers and you knew you were buying properties at a discount. So going in with a hard money loan at 10 to 15% interest, yeah, it might seem scary, but I got 100 grand sitting in equity right now. I can tap into by. I have a couple exit strategies, right? I always like exit strategies. I
yeah,
could do a cash out refinance because I added a ton of value. Yes, I'm paying a lot of money to do it, but I added a ton of value, and I can go get a tax free cash out refinance, put all that money back in my pocket. Or if I have a couple bucks left in the deal, who cares? Or
yeah,
I could sell the property and pay off my lenders, and then use that profit to then be a little less levered on the next deal, right?
yeah.
Um,
When I
so
was doing all that, to piggyback on your point, I mean, I was buying houses for 20 or 30,000 bucks.
wow,
That's in Northwest Ohio, different world than Houston or Naples, Florida, or something. But during that time when all the prices and the values were going way down, the rents never did. I never had to lower rent, and I knew I could rent the house for 600 or 700 bucks a month. And one of the questions I always answered back in those days, especially, and even today to some extent, is if I have to, can I sell this property tomorrow? And if I have to hold it for the rest of my life, am I okay doing that? And that's pretty extreme as far as being conservative. But to your point, I always knew if I had to, I could sell the house, tomorrow morning to any number of investors. And so that gave
yeah.
me even though I was leveraged a little bit in my head with these high interest rates, and just based on my experience, I mean, looking back on it, yeah, I could have exited any time.
So you've done the single family, you've done the multifamily. Walk me through that transition period where you're owning all these properties just yourself, and then you kind of come to the moment where what, I might want to start raising. I'm still finding good deals. Obviously, at some point every investor runs out of money. Um,
Yeah.
and so you're like, okay, I want to start raising money for deals and I'll structure it in the form of a syndication or a joint
Yep.
venture. So walk me through that mindset and that shift. Maybe how many deals did you have under your belt as far as track record? What did, kind of your cash flow look like? Okay, I can kind of I have the experience now where I feel comfortable taking someone else's money
Yeah.
and being, the point of contact for this and them trusting me.
Yeah. So that was 2015. I bought my first multifamily property. So I started in '06. I always tell people it took me almost 10 years to get started, but
Hmm.
that's okay. That's the path I chose. But multifamily was always my plan, really from the beginning. I just didn't have confidence walking into a bank to get a loan for an 8, 12, or a 36 unit apartment complex when I had only managed a handful of single families. So I kind of went through this phase of just acquiring a lot of single families. Then 2015, around that time, I kind of found a mentor, which I don't know why it took me so long to do that. But in 2015, a friend of mine he was buying a larger property and wanted to sell some of his smaller stuff. So I made him an offer, earnest money. I got the property under contract. Really had no idea how I was going to put it together, with the down payment. But I knew him, and I knew I could say, "Hey, I messed up. I can't pull it off." And we had a good track record. I had bought some of his single family houses too. So I went out and I had like a fire sale on a bunch of the single families. I had built up some, just through principal pay down in these shorter terms. I built up enough equity, and I ended up the fire sale worked to some extent. Then I had to have an auction, and I actually auctioned off like 6 properties to get the down payment money. And
Wow.
that's how I got my first 12 unit property, was having an auction where I sold like 7 houses for or around the minimum. I literally
Hmm.
gave away these houses, and and that was okay. I mean, the houses probably combined were as worth as much or more than the multifamily, but that was okay for me at the time because that was the direction I wanted to go. I wanted to get my foot in the door with multifamily. And in that first year, or from 15 to 16, I was able to acquire 3 separate multifamily properties. Um, but yeah, still all on my own with all my own money, my own
Yeah.
resources.
Well, yeah, for the listeners out there, there's a couple of kind of takeaways from what you did. You sold, maybe, 4 to 6 single families to go into a 12 unit. And you might say, well, why would someone want to do that? And a couple of reasons might be the cash flow is better on the
Yeah,
12 unit, better upside, better appreciation, better tax strategy. You can do a
yeah,
cost segregation on that 12 unit. You can also, maybe you did, maybe you didn't, um, defer all the capital gains you would have paid on those single families from the sale, and you do a 1031 exchange, and you exchange those capital gains, so to speak, into that 12 unit. And then also, oh, by the way, from a property management perspective, if you're self managing, not only did I just go from 4 separate buildings, they probably weren't next to each other, I imagine.
no,
Now I'm kind of all under one roof now. So I deferred my taxes. I made my life a little bit easier from a management perspective, and I have better cash flow and better upside as far as appreciation. So that could just be a couple of the reasons why someone like yourself might think about upgrading your single families to a 12 unit, right?
yeah. At that time, I was, and to your listeners out there, if they're so they don't feel bad, there was no capital gain, so I didn't have to defer anything. I just was
Okay.
getting the
All
principal
right.
paid out. I've since done had some capital gains, but at that time, it was more about being able to add value. The 12 unit I knew was under rented, and it had some deferred maintenance. The roofs rolled. There was a lot of value to be created there. Um, a single family is worth what it's worth, occupied or vacant. You can rent out a single family for $4,000 a month, but
Mhm.
that doesn't mean the next guy can. It's worth what it's worth, based on the market. A multifamily is like a small business, as you know. So
Yep.
you add a little value, improve the property, get the rents up, increase the NOI, the net operating income, and you can force appreciation on your own. And
100%.
I had put so much work into my real estate business. And all of a sudden, the market determined that these single families were worth $20,000 a piece. Whereas you put a bunch of work into the multifamily space, you can add hundreds of thousands of dollars, sometimes fairly easily.
Yeah, no, I couldn't agree more. I actually just did. I have a YouTube channel, and for all the listeners out there, if you want to check it out, it's just Mike Doherty Realtor. But I did a YouTube video on the difference between residential and commercial property. And one of the topics I talk about is just that. In residential, single family, up to 4 units, you are a beholder to what your neighbor sells his property for from an appraisal standpoint. So you could add, Tom, you could add all this value, get the best rents in the world. They're still going to use market rents for a comp,
Yeah.
and they're still going to look based on square footage of that single family, what the property, what, Johnny down the street did for his 3 bedroom, 1 bath single family. No, you can make this thing the most beautiful thing in the world. It doesn't matter. They're always going to look at your neighbor's property. So if the neighborhood hasn't changed over, hasn't appreciated, you're sitting on phantom equity, essentially.
Yeah.
You compare that to that 12 unit you bought, and that is based on, from an appraisal standpoint, the income approach to valuation versus the sales comparison approach in residential. And so it's really just numbers based. And that's what I love about commercial. If you just simply increase the NOI because you bought a value add 12 unit, okay, I'm going to increase the income by raising rents or decreasing expenses. Maybe the management was charging way too much. Maybe they hired a ridiculous snowplow guy and he was charging $5,000 a year. I don't know. I'll have my vendors come in and evaluate. I'm going to decrease expenses and increase income by renovating the apartments. Now I take my net new NOI divided by the cap rate, that going time in that area. And now you have you've increased the value tenfold. And you don't care about what the 12 unit down the road sold for as much. It's not as important. So that's the beauty.
Yeah. That 12 unit, well, the most recent one was actually a 12 unit as well. And it was right on a river that runs through Northwest Ohio. And I'm not even sure if the previous owner owned it for 25 years. He was what I call a legacy owner. He was in his 70s and wanted to unload it. I'm not even sure if he knew that he owned the land across the street on the river. I think he probably knew, but I built a huge deck on it, 30, steel out over the river so people could go out and, have a drink in the evening or coffee in the morning, read a book. And the reaction from the residents, it was just unbelievable. I got messages and emails and thank yous. And over time, I didn't want to just jack the rents up immediately. I wanted to provide value to the residents first. You got to look at their experience as residents. Picture yourself in their shoes. But over time, I got the rents for the average $800 a month to about $1,000 a month. Mm-hmm. And just do the math with the cap rate example you just gave. That was about $300,000 in value, and that's what I got. I bought it for $700 and I sold it for $1 million.
There you go. Did you buy anything else with those proceeds, or did you just kind of save it for a rainy day?
Yeah, I turned that into a 72 unit.
You bought a 72 unit, so you took $300,000 profit and you used that as a down payment. And I assume you probably raised other capital for that 72 unit.
Yeah, it was about $1 million.
Wow.
Yeah, 1031. Yeah, and then I raised 300 of my own and 700 of LP capital, which that goes a long way when the sponsor is putting in 30% of the equity. Yeah. That doesn't always happen in larger deals, and that's okay, But this one was, I was managing the property. I had vertically integrated with my own maintenance team and was able to raise $700,000 pretty easily from LPs to operate the deal. Yeah. Now that in the grand scheme of syndications, that's a very small raise and a pretty small deal, but you can do it.
But had you ever done like a raise like that before?
Yeah, I've done some raises on deals very similar to that, and I also started raising money for other people's deals. Which, when I had my first large exit, 2018 or around that time when I sold my first 3 or 4 initial properties, I made this huge chunk of money. I was like, I'm rich. This is great, and at that time, and then 2020, 21, with the beginning of COVID, it was very, very difficult for me to find properties that made sense. I just couldn't. I was like, man, nothing out there. I don't know how these guys are paying this much. And I know they're getting 3 to 4% interest rates, but that's all. That's just that's temporary. How are they going to unload them? I felt like at those times you're just counting on the market doing the work for you. So I think it exposed a lot of operators. So anyway, I started investing in other people's deals because I couldn't find anything locally I liked. So as I started investing my own money into some other people's deals, just naturally, some people asked me, friends or colleagues, like, hey, what do you mean you have a property in Houston? I said, oh, I have this other guy that's a really great sponsor, you know, has this deal. And I walked him through the pitch deck and said, I'll invest with them. And that was kind of the beginning of like the fund of funds and the special purpose vehicles. I didn't even know what I was doing I was doing it at the time. So since then, I've raised money for some of my own deals that I own and operate locally, and then
Mm-hmm.
I've branched out to raise money for some other operators that only ones that I know personally, vet and trust,
Yeah,
and
yeah, you would put your own money into. Yeah.
only deals I put my own money into. Yeah, I don't have like a thousand net investor network or anything, but I just very, very simply tell people just invest where I invest. And a lot of people don't want to spend the time or have the time to do all the legwork and guesswork. So they just ask me like, "What are you doing, man?" And so, and I
Yeah.
actually enjoy all that stuff. Investigating deals, underwriting them, flying out, meeting with the people, whether or not I invest in the deal or not. I just enjoy that. So I
Yeah.
just tell people, this is what I'm doing. If you want to jump along, come on.
Come. So where do you spend your time now? Are you spending two questions actually? How are you finding your deals? Do you have brokers reaching out to you? Do you do your own off market kind of postcard or cold calling direct to owners? How are you finding deals? And then how do you spend your day? Like from the time you wake up to the time you go to
Yeah.
bed, how does your day look like?
Yeah, a lot of it's investor reach out. In these days with just the way it is in social media and your content, you have to stay updated. Keep your investors updated, keep them engaged with what's going on, good or bad.
Hmm.
So I spend a lot of time talking to people, but I really like to look at deals. I like to look at multifamilies. There's a few markets I kind of focus in, a few different groups that I spend most of my time analyzing their deals. And I've also recently kind of got into some income funds and some real estate debt funds. A lot of investors, that got burned or just didn't have a good experience in the last cycle. They don't like a 5 or 7 year lockup on their money. So I've kind of invested money personally into some regular income funds that support small business financing. They're only 12-month lockups. So I spent a lot of time underwriting those deals, figuring out how, because that's not a world I was used to, when I first started. So how do they do their borrower intake? How does their investor reporting look? What's their average business owner look like? How many years in business? How much monthly revenue? What's their average credit score? I just ask all the questions that a lot of people probably even don't know to ask or maybe feel uncomfortable asking. So I'm just like a deal junkie, man. I just find deals and talk to people. Like I enjoy talking to like podcasts like I'm doing right now, and going out and actually meeting the people, walking their properties, and I just am generally curious about what other people are doing, and then I kind of find what I agree with the most, with what fits best with my as far as integrity and their ability to deliver returns.
Hmm. Yeah. So what does your day look like? Today. What's your today look like?
Well, I had a
This is
10
Monday.
o'clock.
We're recording this on a Monday.
Okay, so I had wake up in the morning and I fight with my daughter for like a half hour, and I don't know how to brush her hair very well. So that's always that's my biggest challenge every day is all the tangles. And my wife, thank God for her, because I don't know I can barely do a ponytail. So that's like the first half hour. And then I had a 10 o'clock, 11 o'clock investor meeting. I met with my marketing team just to go over how we're how we're reaching out to our investors, staying good communications. And marketing is one of the things like I've recently kind of taken on and understood is important. I never did that before when I lived in my own world in Ohio. I always had the keep it small, keep it all kind of mentality.
Mhm.
But now when you have other people's money involved, all that stuff becomes really important.
So do
Doing
you
this
hire your
podcast.
marketing team for like distribution updates, marketing updates, letters, all that stuff?
Yeah, just to stay engaged with what I'm thinking, what I'm seeing in the market. So I have a
Hmm.
weekly newsletter. Um, and the marketing guy, I don't like, there's so much AI and all
Yeah.
that stuff out there in the world. And I know it's very important. I probably should spend more time like with AI to as far as automation, but my marketing guys are just good with like graphic design stuff, because I just hate that stuff.
Yep.
That's not my
Yep.
world. But yeah, investor updates, newsletters, market insights.
Yep.
I tell
Okay.
people about all the deal. Maybe not every single deal, but I'll send out deals that I've underwrote and send it out not as a deal alert because I'm not doing it. But I don't know if how many people read them or not. But I like to even show what deals I'm not doing and
Right.
explain why.
Right.
And people get a lot of value out of that. I think they say, "Hey, thanks for that."
Yep.
Then I have a meetup later tonight with some local guys that we get together every couple of weeks and just talk about our market here locally and what we're seeing. And um, where I live, there's not a whole lot of new development. A lot of it's a lot of older vintage stuff, 80s, 70s built stuff, but there's still some value there. And so we get together once every week, once every couple of weeks, and kind of just share ideas, share our thoughts. And so that's what I'll be doing later.
Nice. All right. Good stuff. Pack-filled day.
Yeah, I
Where do
stay
you
busy.
where do you see the future of North Corp going?
Well, I've thought about that a lot, and people have asked me, do I want to have like this big nationwide network of investors where like Alex Hermosi, where you see me on Facebook and YouTube everywhere, and I don't think that's me. I feel like I just have to be able to serve the investor well. So I feel like maybe 100 investors. I just want to be able to serve 100 investors extremely well.
Yeah.
So right now is interesting in the multifamily space with a lot of these. Um, those loan maturities coming up from the deals that were bought in 21, 22. So I think there's going to be a lot of opportunities in the multifamily space. So I have a few markets I focus on, some growth markets to try to find some deals. Um, Again, with some real high level proven operators. But I do see uh, the debt funds and some of these other private alternatives. I feel like it's a $4 trillion industry right now, and I've read a lot of statistics and a lot of articles about it. I think that'll triple in the next 6 or 7 years. You'll see a lot of people just like me and you investing on Main Street instead of Wall Street. So I think you'll see a big shift away from the stock market, where people need to find
Mhm.
these really good, solid vehicles to, even if it's a cash flow play where they're just earning 10 or 12% and no equity. There's just a lot better places and a lot less volatile places to put your money, and that's in the private world, alternative investing. And I feel like there's probably not as much education out there in that space as there should be. But I think over the next 5 or 6 years, you'll start to see that become more mainstream.
Yeah. Yeah. No, I couldn't agree more. Honestly, no,
I hope I
that's a
answered your
good thought.
question. I just started rambling, so
No, you're good. You're good. Well, I appreciate your time. I know you're a busy guy, so I'll let you go. But if people want to find more about you, learn more about you, where can they contact you?
well, if they want, I'm probably most active on LinkedIn. Thomas St. John. You can just look me up on LinkedIn. Otherwise, just go to northcorpcapital.com. Send me an email. My phone number's on there, and I respond to every single one.
Awesome. All right. Well, and we'll be sure to link all the show notes in the episode down below. And if you like what you heard today with Tom, be sure to like and subscribe. We're on Apple, Spotify, and SkyTreeInvestments.com. So I appreciate everyone listening. Thank you, Tom, and we'll talk again soon.
All right, yeah, pleasure being here.
Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.